lot of news this week made by the Fed, and Chair Powell is trying to walk a tightrope, and he's certainly getting a lot of feedback, both positive and negative, because of that.
There he is. And I think part of it is just because he really keeps talking about how there's so much uncertainty in the outlook that he doesn't really know what they're going to do next. And I think that he's really been rightfully criticized for that, because the Federal Reserve, they do need to be forward-looking. What they do today is going to have repercussions for months to come. And so if they don't have really a good view of the future, how can they set policy today?
And let me just say, Brian, they have always looked backwards.
Yes.
And not forwards. And so a view of the future is something that they generally don't do, because they like to say we look at facts and circumstances and what's the fact pattern, and then they're going to make decisions. Well, that's looking backwards. And so looking forward has been difficult for them, and that is the reason why so many people are frustrated. Why do we spend so much time talking about the Fed? Because interest rates are important to everyone.
They really are. If you think about if you're a lower income individual or even an upper income individual with, say, credit card debt, most of that is actually, unfortunately, held by lower income individuals, and they are really feeling the pinch of these higher rates. If you look at the average credit card rate, it is somewhere close to 25%. I mean, that almost sounds ridiculous that we have credit card rates that high.
And the debt has been going up, and we've seen that credit card balances have been going up. So the normal person is starting to see their balances go up, and they're starting to pay higher interest rates. But that's part of the bigger picture,
yes,
which is inflation. Inflation over the last number of years is up between 20 and 25%. And I have to tell you, I want to explain this because this conversation happened yesterday with a well-heeled person. Inflation is the rate of change, and I want you, Professor, to explain what this is, because not everybody gets it.
Yeah, and actually, I'm glad you bring that up, because I had that conversation with a reporter as well, where he was talking about, well, if inflation is coming down, why hasn't the price of milk? Why hasn't the price of cars? Why haven't those things come down? And I had to explain. The Consumer Price Index, this is the level of prices. The inflation rate is the change in that level. And so to say that inflation is coming down just means that those prices are rising more slowly. They're still rising. It's just doing it at a slower pace. That's a huge difference. And I think it's a massive disconnect between the public and the Federal Reserve, or you could even say between the public and economists in general about the way that we look at this. Why would it be considered a victory to get inflation down to 2% if it just means that we're stuck at this level, and we're not actually stuck? It keeps going up.
And so that's the common man has got to understand that there is a difference between prices and inflation. It does not mean that the gallon of milk is coming down or the gallon of gasoline. It's just not going up as fast as it was. And that's an important distinction. So that's number one. Why do I bring that up? Because we had a CPI report this week.
That's right. And the CPI report was refreshing to see that the May inflation rate month on month, so the change in the price level, was actually 0% from a headline level. Now, a lot of that was because you had about a 2 to 3% drop in the price of gasoline. Thankfully, the price of oil has come down lately, and so that kind of helped pull that price level down. But when we look at the year-on-year change, which I think is what most people are going to pay closer attention to, that's still around 3.3 to 3.4%. So if you look at the general price of things that you bought a year ago, where are we now? It's 3.3% higher.
And by the way, this is an arbitrary number to some extent that the Federal Reserve picked 2%.
It is.
Because the long-term average is much higher. It's between 3 and 4%.
Yeah.
And they picked 2% after they put the zero interest rate policy, ZIRP, in place.
Yep.
So they kind of pinned themselves back into the corner.
Yeah, and it's actually kind of fun to look at the history of this. The central bank in New Zealand is the first one who actually picked 2% as an inflation target. This was back in the late 1990s. And they were asked, why did you pick 2%? And they said, well, it just seemed like a good number.
That's crazy. Yeah, that's crazy.
So it is fairly arbitrary. But if you actually look at the statute that gives the Federal Reserve power, it says that they should pursue full employment, stable prices, and moderate long-term interest rates. So it says
and where does
stable
politics
prices
come into that? Because obviously they're in that game too, and I'm just joking.
Oh, no, that's true. But stable prices, it says stable prices, not stable inflation. They've just reinterpreted it to mean stable inflation. Now, I think the reason why they're looking at 2% now is that it really is just history. right? A lot of people would say, well, why don't they change it? Based on demographics, debt, things like that, deglobalization, maybe they should actually have a higher target. I think that they would really be doing themselves a disservice if they did decide to change that target.
And they'd lose credibility for
Yes,
sure, because
exactly.
they've done all of these things over these years to try to get to this 2%. And one of the reasons they can't get to 2% is real estate. And part of that calculation, called renter's equivalency,
Yep.
that is one of the reasons why they can't get to their target.
Yeah, that's the part that has really been the stickiest part of inflation, is that you have, if you rent an apartment, right, obviously you can see what that rent cost is. For most people, that's only going to change maybe once a year. And so the Bureau of Labor Statistics, who calculates this, they kind of smooth that out. They're like, if you get a rent increase at the beginning of the year, let's kind of spread that out over the next 6 months, so that way it can kind of build into it, because otherwise you'd see a massive spike in inflation every January.
So we talk about inflation. We've talked about interest rates. Where is the stock market going? Well, it's continuing to go up. And by the way, we're in between earnings season right now.
Oh, yeah.
So all of this could come together in a conversation. And folks, don't forget that right now we have an election coming up. And unless you're underneath a rock, you do know that. And this is going to be part of the conversation. What will the Fed do? Will they cut rates in September, for example, before the election? And what will that do to investor psyche? What will it do to consumer psyche? This is a big part of the conversation. All the reason more that you need to have it as part of your financial plan.